The biggest danger to the US tech bubble may not be coming from Silicon Valley. It might be coming from Tokyo and Beijing. Right now, two powerful forces outside the United States, Japanese investors and China's accelerating ultra-efficient AI ecosystem, are aligning in a way that could amplify or even trigger a massive correction in US markets. And the most alarming part? Almost no one is talking about it. For the past 2 years, US tech stocks, fueled by relentless AI enthusiasm, have carried global markets almost single-handedly. The Magnificent Seven dominate the S&P 500 at levels we haven't seen since the dot-com era. A huge share of US GDP growth comes from just a handful of companies whose valuations assume years of perfect execution. But when expectations rise faster than reality can deliver, even small external shocks can destabilize the entire system. And those shocks are forming right now, originating not in America but in Japan and China. Japan has quietly become one of the largest foreign holders of US equities over the last decade. For years, Japanese pension funds, insurers, and retail investors have sought higher yields, channeling their money into US tech stocks. This trend thrived under ultra-low interest rates and financial repression. But times are changing. Japan is now raising long-term rates, with 40-year government bonds yielding nearly 3.7%, a level unseen for decades. Coupled with significant fiscal stimulus, Japanese investors suddenly have attractive domestic opportunities that have been scarce for a generation. As the yen strengthens and bond yields rise, US tech stocks may become less appealing and riskier for Japanese investors. This could lead to a major capital rotation out of the US, sparking significant selling pressure. Once the domino effect starts, hedge funds, ETFs, and global asset managers typically follow suit. With the US tech sector so concentrated, even a slight shift in foreign investment could lead to serious turbulence. While Japan is preparing to bring money home, China is building a threat of an entirely different kind, a rapidly advancing, highly cost-efficient AI ecosystem that undermines the core narrative behind the US AI boom. China now produces far more AI-related patents than the US, Europe, and Japan combined. Elite institutions like Tsinghua University are surpassing Western research powerhouses. The Chinese state is pouring billions into AI labs, semiconductor R&D, national compute clusters, and subsidized energy for data centers. National compute clusters rise like infrastructure in miniature. China's STEM pipeline is enormous. Over 5 million graduates in 2024 alone, many of them entering AI, hardware, and advanced computing fields. The world got a preview of this shift with models like DeepSeek, which demonstrated that China can produce competitive AI at a fraction of the Western cost structure. If China continues to reduce compute needs, develop software-level efficiencies, and build alternative chip architectures beyond US jurisdiction, the US narrative of AI supremacy begins to crack. Because the underlying story that justifies today's sky-high valuations shifts from the US will dominate AI and capture most of the economic value to AI is becoming global, and China can do it cheaper, faster, and at scale. When that narrative changes, the valuation premium that US megacaps enjoy can evaporate quickly. Now imagine these forces hitting at the same time. Japan begins pulling capital out of US equities. The dollar weakens, algorithms trigger sell-offs, tech stocks start to correct. Meanwhile, China unveils a new breakthrough. A lower-cost model, a new AI architecture, or a massive state-coordinated deployment. Investors begin questioning the core assumptions behind US tech valuations. The market realizes expectations have stretched too far. Capital becomes nervous. Valuations start to fall, often not gradually, but violently. Historically, major market downturns are triggered not by internal weakness, but by external shocks that puncture unrealistic assumptions. Not because US companies suddenly become weak, but because the global environment shifts in ways that the bubble was never priced for. None of this guarantees a crash. Bubbles can last longer than anyone expects. But the risks are rising, month after month, as global dynamics evolve. The real question now is, can US tech maintain its premium? Or will global forces, Japan's capital shift and China's AI surge, finally catch up to it? What do you think? Is the US tech bubble on the edge of a globally triggered correction? Or can the AI boom keep the momentum going for years? Share your thoughts in the comments. And if you want more deep dive content on global markets, AI, and geopolitics, don't forget to like the video, subscribe, and hit the bell. Stay alert and stay informed.